Welcome to Kaplan Professional's Monthly Economic Update. I'm Michael Pollock, and today we're speaking with Senior Economist at ANZ, Felicity Emmett, about the RBA's recent Financial Stability Review. Thanks for joining us, Felicity.
That's a pleasure.
Firstly, what were your key takeaways from the RBA's review with regard to the outlook for the Australian economy, and more specifically interest rates for 2018?
Well, I think there's a couple of things to focus on. I think firstly, there's obviously the housing market, which is always a big focus for the Financial Stability Review. And I think it makes clear that the RBA is not worried about house prices per se, but they're really more worried about household debt. Now, I don't think that they think that there's going to be some sort of sharp adjustment there, but they're worried that if there was a shock from offshore, that would be amplified through the Australian economy because of that high household debt. And I think they're also worried that this combination of high household debt and low wage growth is weighing on consumption spending at the moment. And the other area I think that was the focus of the RBA in the FSR was this idea of this search for yield, these low yields everywhere, low volatility, in a part of the cycle where central banks are starting to raise rates or reduce quantitative easing. Inflation is looking like it's starting to ease up slightly. And so I think that they are concerned that there could be, at some point, abrupt adjustment in the markets.
The RBA raised concerns in the review that the combination of low interest rates and low volatility in financial markets was promoting excessive risk-taking among global yield seekers. What does this development mean for more risk-averse investors seeking secure and reliable income from their investments?
Yeah, look, I think that that is a concern. When you look at things like credit spreads, they're incredibly narrow. And I think that, there's a possibility that we see perhaps a sharper pickup in inflation than markets are expecting, and that central banks may have to scramble to catch up. The bond market might adjust quite quickly, and then you can have a situation there where some investors are exposed, and that can perhaps amplify the shocks through financial markets and through economies. So I think that's where the RBA is worried. Not that they have a central case that there is going to be a problem, but that these abrupt adjustments in markets can have flow-on effects into the economy.
Globally, there are currently a number of geopolitical risks for analysts to contend with. Trump's provocation of North Korea and Iran, the ongoing Brexit saga, high corporate debt and shadow banking in China, and the rise of populist politics, to name a few. What geopolitical risks, in your opinion, have the greatest potential to distort capital markets, and which risks are you watching with particular interest?
Look, the geopolitical risk is always an interesting one. We look at all of them and keep an eye on all of them, but it's always very difficult to quantify how that could or would impact markets. So we keep an eye on all of these things. I think, though, for Australia, we really are more focused on China. Australia's economy is so linked in with China now, not just for selling our iron ore, but we also sell a lot of our services exports to China. They're our number one tourist arrival. They are heavily invested in both our residential real estate market and commercial real estate. So our fortunes are very much tied to China. So that is where we really focus on in terms of the risk of some sort of external shock. And that's what we will be looking for. It's certainly not our central case, but that is something we watch out for.
Could you just elaborate on the shocks that you're watching in China?
So I suppose in terms of China, perhaps it's less geopolitical risk and more economic and financial stability risk. I mean, as you mentioned yourself, and the FSR mentioned, there's a high level of shadow banking. Their financial system is quite opaque to some degree, and so I think we'd be worried that perhaps there could be perhaps a policy misstep, and that some abrupt adjustment again could be amplified through the economy given their very high levels of debt, and that then impacts on the real economy that flows through to Australia. So I suppose that's where we see the largest risk. I mean, we hear a lot about the capital controls and how that's going to affect the money coming in from China, and over the last few years there have been many instances where there have been anecdotes that the gates have closed, but that hasn't actually been the case, and there's really hasn't been any signs that flow of money out of China has stopped, even though probably their interest in our real estate market is gradually slowing.
Looking more closely at Australia, what, in your opinion, will it take for the economy to break out of the cycle of low interest rates, low wages growth, low unemployment and low inflation?
I think probably we're actually past that cycle. I mean, when we look at unemployment, that actually has been declining for a little while, very, very gradually, but it has been declining. And importantly, we've actually seen a decline in the underemployment rate recently as well. So we are seeing a reduction in labour market spare capacity. Inflation also looks as though it has troughed. So headline inflation is well up from its lows, and core inflation is also trending higher, very gradually, but it does look to have troughed. So I think we are really out of that cycle now, and our view is that we will actually start to see interest rate rises from the RBA next year. So I think that we're sort of at the bottom, and things are, the economy is gradually improving, labour market spare capacity is gradually reducing, and that will eventually see wage and price inflation go higher, and so the central bank can return the cash rate to something closer to normal, but that process will be very slow.
So Felicity, what's the significance of the Phillips Curve in all this, and is it really broken?
Yeah, no, this is a really interesting concept, I think. And our view is that it's not really broken, but it's certainly flatter than it used to be. And I think that there are a number of factors going on there, and some of them are structural and some of them are cyclical. So if we look globally, there has been a worldwide slowdown in wages growth and when we look at many countries, the US is a good example. Even though their unemployment rate is very low, wage growth has been very slow and gradual to pick up. But I mean, it is picking up in the US. It's well off its lows, but not where you would expect it to be with an unemployment rate of 4.2%. But I think there has been a real much higher correlation now between wage growth across countries, and a lot of that has to do with globalisation and this integration of different economies, and the extension of supply chains has meant that not just goods inflation, but also services and labour market competition has increased. And so that has been put a downward impact and a structural sort of downward weight on wage growth around the world. There's also the impact of technology, which I think in lots of ways is harder to quantify. But at the very least, technologies affecting job security, so people feel as though they can't ask for a pay rise because then their job could be replaced by a robot or some sort of automated process. And this is happening across professions. It's not just for people working in a car plant where they're doing something quite manual. It's moving into quite highly skilled professions, as we know, lawyers, these things. And so it is across the board, I think. So those two things are structural sort of weights on wage growth. But then we've also had the cyclical factors. I mean, around the world, we've had quite significant spare labour market capacity, and certainly in Australia, we still still have that. We're sort of behind in terms of the cycle. We also have, and this is a case around the world, falling inflation expectations. That has stabilised now. And then in Australia, we've had sort of the leftover residual impact of the mining boom, where wages did go very high and now there's had to be some adjustment. And so I think that there's this combination. So we will see that cyclical pickup eventually, but it won't be as strong as it would normally. So, and that goes back to that flatter Phillips curve.
There have been recent signs of conditions easing in overheated housing markets such as Sydney and Melbourne. What's your outlook for these markets for 2018, given the persistence of supply issues?
Look, we think we will continue to see some easing in house price pressures. So we expect house price growth to slow. We're not really looking for falls, particularly in the Melbourne and Sydney markets. And a lot of that, though, is in response to the tightening of macroprudential measures earlier in the year that were targeted towards investors. And we think that that is really helping to take some of the heat out of the market. But I think in Sydney in particular, we had a long period of underbuilding. So I don't think there are too many issues about absorbing that supply. We've also had relatively solid population growth for a long time. We're taking a good proportion of the new immigrants to Australia, and that's helping to keep housing demand quite strong. In Melbourne also, they've had very strong population growth, and even though they've got more supply coming on stream, they do seem to be absorbing that supply relatively well. We are seeing some weakness in apartment prices there, but at this stage it doesn't look really to be too concerning. And given this ongoing strong population growth, we're pretty comfortable with that market. The market that we're more worried about is probably Brisbane, given the increase in supply there compared with their stock is very large, much larger than the other two cities, and they haven't had the sort of population growth that Sydney and Melbourne have had recently. It is picking up, so that will help, but there is a lot of stock coming on stream there, and they're already seeing apartment prices fall and vacancy rates rise. So that market, I think, is possibly in for more of an adjustment than the larger Sydney and Melbourne markets.
The RBA review suggested a scenario where high household debt and vulnerability to negative shocks had the potential to lead to bank losses, scarcity of available credit, and even slow economic growth. What are the implications for investors in the likelihood of this scenario playing out?
Yeah, look, I think this is quite a serious risk. It's neither the RBA's central case or our own, but is definitely one of the biggest risks out there, that we get an external shock, perhaps from China, and then the implications of that are amplified because of the very high household debt. It's higher than any other G20 country. So, and already we're seeing some weight on consumer spending from not just the high household debt, but this combination of high household debt and low income growth. But what I think the Reserve Bank is worried is that we get some external shock, unemployment rises, then you see house prices, which are actually much more sensitive to unemployment than interest rates. We see house prices come back quite significantly. A lot of borrowers who have borrowed recently, who perhaps have very small buffers, would be exposed then. If they also see a decline in their income, then they would have to sell. And so then you could end up with a bit of a cycle there where you have falling growth in consumption, then lower GDP growth, higher unemployment, lower house prices. And in that way it flows through the economy. So I think that this is the Reserve Bank's main concern, and ours as well. I don't think they're so worried about bank stability. I think they see the banks as being in a very good shape, unquestionably strong, in the top quartile around the world. So I think that while the macroprudential measures that they've introduced have tried to discourage any sort of overly eager, zealous lending by the banks, I think that they're comfortable that they're actually in relatively good shape to withstand that shock, but they're more worried about the economic growth issues.
Thanks very much for your time today, Felicity.
That's my pleasure. Thanks.